Hey everyone. So I hope you all are doing good. So guys, today we are going to start with our new chapter, which is very easy chapter, I would say, cost reduction and cost control. So it's not big chapter at all. So let's read about cost reduction and cost control. But before starting, let me give you a brief about cost reduction, what basically cost reduction is, and what basically cost control is. See, what comes in your mind when you hear the word cost control? So cost control is a thing where we used to control our cost. Okay, we used to control the total cost which would occur in our business. Now, what is the meaning of control? Control, we can say, is a way to you know uh, divert the cost, dilute the cost as and when we want, and whatever we want for the cost, we just want the cost to be there in that bucket only, in that bracket only. So you can say, what if I give you some examples of cost control? I can say the standard costing can be an example. I will say budgeting can be an example. Now, what is budgeting? What basically it is an example of cost control. So budgeting, what we used to do in budgeting, we used to prepare a budget. Okay, we used to prepare a budget that yes, for the full year, we are expecting this much amount of cost to be incurred throughout the period. Okay, and what used to be our target? Our target used to be that during the period, we should not incur a cost more than that. So it is a way to control the cost. It is a way to control the cost. Suppose somehow if we see the cost is going up, if somehow we see that the cost is going up at the end of the year, our target cost would somewhere be crossed to our budget. Whatever budget our target, our actual cost would go more than that. Okay, if we see that, then the cost reduction comes in place. Then the cost reduction comes in place. Okay, so basically, cost control is a technology where we used to, which is basically used to control the total cost. The total cost. Okay, we wanted to control the total cost. That's where the cost control things come. Okay, now there are certain steps involved in cost control. The first is planning. Firstly, we need to plan the cost. We need to set a target cost. Okay, we need to plan the cost. We need to set the target cost. Again, we need to make the budget, standards, estimates during the period that yes, this would be our target cost, which and above which we should not go. Okay, this is the maximum cost which we can incur. Okay, if we are going beyond that, we need to follow the cost reduction. Okay, so this is a target, this is a standard which is set by us. So this is a first step of cost control, that firstly you set up a target cost. Firstly, make the planning, and what basically is done in planning, you will set up the target cost. The second step would be communication. Now you have set up the targets, but you as a senior manager, you are not responsible, you are not whole responsible for cutting the cost. It would be the department head, or you can say the supervisors, or the particular project head who would be there for implementation of that cost target. Okay. Me, suppose as a finance controller, I do not know what is the basic activity done in my factory. Okay. So I will prepare a chart based on certain analysis, and I share it to the concerned person, to a person who is actually responsible for the activities. I will share him the draft, the standard, and I will instruct him that this is the standard prepared by us, and now it is your responsibility to keep the cost within this bracket. So second is communicate the target set by you to all level of persons, whether it be managers, whether it be supervisor, whether it be project heads, whether it be the employees or the laborers. Why laborers as well? Because what used to happen, that there used to be a chain. There is manager, then deputy manager, then again project head, you can say, then the supervisors of a particular activity, then laborers. Okay, so it start from here. If you wanted to control the cost, it start from the below level people, because they now at least need to know that for making a particular, suppose for making a particular thing. Let's take an example. Let's for making a particular laptop. Sorry. particular calculator, what was your earlier product available to you? Earlier you were available 1 hour to make a particular calculator, one calculator, okay, and you will be provided around 1.2 displays. 1.2, how 1.2, like for 12 calculator, sorry, for 10 calculators you are being provided 12 displays. So two displays would be, you can say, you can, if there is some scrap or there is some wastage, so two, there would be a margin of two displays. But now laborer need to know that the management has changed the decision. Now management is saying that there would be only 15 minutes, 50 minutes allocated to a person, one calculator. For making one calculator, there would be 50 minutes, and rather than 1.2 displays, there would be 1.1 display only. Okay, so there would be 11 displays to you available. Okay, there would be a margin of one display, or margin, you can say, if there may be some scrap, or there may be, some wastages during the processing the calculator. So there would be a margin of one display only. Earlier you were having a margin of two display, but now you will have a margin of one display. So if you will communicate this process, this particular program to a laborer, so they will also be aware that yes, we need to be more cautious now, because we are having only one extra display in 10 calculators, and we are having, you can say, 10 minutes less for one calculator. Earlier we were allowed 1 hour work, but now we are allowed only 50 minutes to work on a particular calculator. Okay, so this is a general example I'm giving. I know that calculators are not made by the people, but it's a general example I'm giving. So it's a communication, like you are communicating the plan of the top management to all level of people. Now, what motivation? So once the plan has been, set it up, the people, the plans are told to the people, they are given the standards. Now, it is about motivate the people to achieve the result, to achieve the target cost which you have set it up. So if you have set up the target cost, it should be your responsibility to motivate the people to achieve that, standard, that target cost. Now appraisal and reporting. Now the actual performance, whichever, at the end of the period, whatever actual performance you have done, it need to be compared with the predetermined plan. You can set targets or budgets. Okay, you'll compare it, and now whatever the deviation is there, you need to take suitable action against it. Okay, now decision making, the variances are reviewed, or variances means actual and standard. Difference between actual and standard, these are reviewed and decisions are taken. Okay, corrective actions and remedial measures of the revision of target. Suppose at the end of the period we saw that there is a huge variance between target and the actual. So target was that we need to complete a particular project in 1 lakh rupee, and we are getting a cost of 1,50,000. So we need to now see whether we need to change our target, whether we need to increase the target, or whether we should change our procedure of project. Okay, whether we need to change the procedure, our operational things we need to change so that the cost can be reduced. But if reducing cost up to 50,000 is somewhere you can see it's unachievable, then what would be your step? You need to revise the target. You need to say that yes, this target which you have set it is not achievable. So we need to make an achievable target, because see, suppose my capacity of working is, suppose I make a suppose I make a pillow. Okay, I make pillows. So my capacity to make a pillow, basically, suppose in one day I can make 10 pillows. Okay, in one day I can make 10 pillows. Okay, it's my capacity, it's my normal capacity. Okay, in normally I make 10 pillows a day. Someone is saying that you need to make 12 pillows. Okay, what would you say? I can try. Okay, if I'm making 10 pillows, there is chances that I can make 12 pillows. Okay, but someone is saying that you are having one day make 25 pillows a day. Okay, what would be my step? Definitely I cannot do that. If I know that I cannot do that, okay, if I know it is not possible for me, I would not even try for that. So that's why revising target is equally important than changing the procedure and reducing the cost. Making an achievable target is very important, because if you will set an unachievable target, people will not even try to achieve that. Okay, so in this case, yes, it is an achievable target, but making 25 kilo a day, it is unachievable for me. Okay, so that's where revising the target is equally important. Okay, done. Now, what are the advantages of cost control system? Achieving the expected return in capital employed. Okay, we know that. Increase in productivity. Okay. Reasonable price to the customers. Yes, because if we are setting a target cost, it means the price would be somewhere reduced. Continued employment and job opportunity to the workers, economic use of limited resources, increased creditworthiness, and prosperity and economic stability in the industry. Okay. Now, what is cost reduction? The next term is cost reduction. After cost control, there is a next term, cost reduction. Now, what is cost reduction? Cost reduction is reducing the cost, reducing the cost. In cost control, we used to set the target and keep the cost within the target. But in cost reduction, we want to reduce the cost from the earlier level. Whatever the earlier cost was, we need to reduce it. Okay, so that is what cost reduction is. Okay, so there are two different things: cost control and cost reduction. Now, see, if you are thinking about achieving profit, what return here is that if you're thinking about achieving the profit, there are two ways, definitely two ways. One is either you can increase the sales or you can reduce the cost. Okay, first thing is easy. The first point is easy, that you can increase sale price. Okay, first point is easy, that you can increase the sale price. But if you increase the sale price, if you increase the sale price, your sale volume will go down. Okay, 11 12th class economics, I hope you guys know that if you increase the sale price, the sale volume go down. Okay, so if sale price is increasing, sale value, sell volume is going down, it means overall sell would either decrease or would remain same. Okay, either it would decrease or it would remain same. There are hardly any chances that it will increase. Okay, it's a normal economic concept. Demand, supply, the price and relation between price and supply. If price goes up, supply goes down. It's a normal economics. Okay, so that's where the second point comes, that cost reduction. If you're reducing your cost, it means the sale price is there only, but the cost which was here, it's going here. It means the profit is increasing. So the second way, it is much achievable. Yes, you need to make efforts for the second way, but it is achievable. Okay, so this is what cost reduction is. Now, difference between cost control and cost reduction, very easy. Cost control presents the effort made toward achieving the target, and cost reduction, it represents reducing the cost. Okay. Process of cost control is set up of a target. We know, okay, achieve the target, investigate the variances. The cost reduction is not concerned with maintenance of performance according to the standard. It is all about reducing the cost. Here we need to make some targets. Here we do not need to make any of the target. You just need to reduce the current cost. Okay, the cost control assume existence of standard or norms which are not challenged. The cost reduction assume the existence of concealed potential saving in standards or norms which are therefore subjected to constant challenges with the view to improvement by bringing out savings. Okay, it's simple thing written here, that it is not all about any standard or anything. It's simply reducing the cost. So all the things written here is same, just language is changed. Okay, so you can read it once. It's a prevention function. Okay, it lacks dynamic approach. Okay, it's a corrective function, that whether earlier there was a high cost, now we have corrected it, we have reduced it. Okay, the cost reduction, a continuous process. We have read it in Kaizen as well, Kaizen costing, continuous improvement. I hope you guys know it. So this is all about cost control and cost reduction. There's one question as well given regarding cost reduction and cost control. Let's read. Ever Forward Limited is manufacturing and selling two products. splash and flash. The selling price is given to us rupees 3 and rupees 4 respectively. The sales strategy, sale planned is 7.2 lakh in case of splash and 3.5 lakh in case of flash. Okay, so this is the sales strategy, the sale value, sell volume. Okay, now break even point is also given to us. Okay, now profit figure is given to us for splash and flash. Okay, so it's an easy question, I think. Okay, profit also given, it is 69120 and 17500. Okay, that would be possible by launching the cost reduction program. Now current uh, fixed cost is given to us 1,08,000 for splash and 27,000 for flash. So I hope you guys know the concept of break even, which we have already read. I hope you guys know those concepts. The break even cost, the margin of safety, that would definitely play an important role here. So I hope you guys remember that concept. Otherwise, there would be a revision for you guys. Don't worry. Okay. So selling price of splash and flash will be reduced by 20% and 12.5% respectively to meet the competition. It would be reduced to meet the competition. We're required to present the proposal in financial terms, giving clearly the following information. Okay, the number of unit to be sold of flash to break even, as well as the total number of unit of flash and slash sold during the period. Okay, number of unit to be sold for splash and flash to break even. Okay, so firstly we need to tell what should be the unit sale to achieve the break even. It is sale planned. It's a planned sale. So let's see the first point. It is illustration number 70. See, there are two products, flash and flash. Correct. Now what details are given? Details given are that sale planned for the year is 7.2 lakh rupee and 3.5 lakh rupees. So sale value is given. It is 7 lakh 20,000 and 3 lakh 50,000 for a year. Okay. What first point is asking us? It is asking us number of unit to be sold of splash and flash to achieve break even point. So firstly, let's see number of units to be sold. Let's calculate the number of units. So it is the total value. Okay. Now what is the sale price? See, sale price is given to us rupee 4 and sorry, rupee 3 and rupee 4. It is 3. Rupee 3 and rupee 4. And it would be reduced by 20%. So 80% we will take, and it would be reduced by 12.5%. So I can say 87.5% we will take. Correct. So let's see what would be the revised sale price. This is planned sale value. This is planned sale value. I hope you know it is planned sale value. Okay. So, and it is sale price which we are expecting, which we are planning. Okay. So 380%, it would be 2.4. I hope what it is. You know what it is. We have reduced it 20%, so 80% is remaining. We have reduced 12.5%, so 87.5% is remaining. Okay. It is 2.4 and 3.5. So let's see sale volume. It is 1 lakh. Correct. And 720 divided by 2.4, it is 3 lakh. This is the total sale volume. This is total sale volume which we are planning. Okay. Now it is given to us that break even is 60% of the total sale. So break even is 60%. So you can say break even is 1,80,000 and 60,000. This is the break even sale, and what it is asking us, number of unit to be sold for splash and flash to break even, as well as total number of unit flash to be sold during the year. Okay, so number of unit to be sold for break even. So this is the answer of first point. It is the number of unit to be sold for break even. Answer to point one. Okay, it is number of unit to be sold for for break break even. I'm sorry, number of unit to be sold for break even. Okay, so this is the first point, and there's a second point as well, uh, for break even, as well as the total number of unit of splash and flash to be sold during the year. So this is also, we have calculated the total number of unit of splash and flash to be sold. We have calculated it, like total number of splash and flash to be sold during the year. So it is 3 lakh and 1 lakh. Okay, so first point is done. First point is done. Now the second point is reduction in fixed expenses product wise, that is envisaged by the cost reduction program. Okay, so reduction in fixed expenses. What is the reduction in fixed expenses? Okay, so let's see the point number two, calculation of reduction in fixed expenses. See, some of the details are given to us. Okay, splash and flash. So first thing is total sale. We know it is 7,20,000 and 3,50,000. Correct. And what is the break even sale? So break even sale is 1,80,000 and 60,000, 1,80,000 and 60,000. And what is the price? Price is 2.4 and 3.5. Correct me if I'm wrong. So it is 1,80,000 multiplied by 2.4 would be 4,32,000. Correct. And 60,000, 63,210. Okay. So this is the margin of safety. I hope you guys know what is margin of safety. We have already read this. Margin of safety. What is margin of safety? Minus 7,20,000. It is 2,88,000 and 1,40,000. Now, what is margin of safety? What is the margin of safety? So margin of safety, let me explain you once. Margin of safety is a point, upon which, over which, basically there would be only variable cost. Okay, there would not be any fixed cost. See, let me tell you an image. See, suppose this is our variable cost. Okay, and this is our fixed cost for a particular products. For a particular product, suppose it is 10,000 product. For 10,000 product, it is our fixed cost and it is our variable cost and it is our fixed cost. Okay. Now, break even point is a point where we feel we face zero profit situation, where we face zero profit. So for 10,000 units, suppose there is, at this is the break even point. Okay, so at this point we are facing zero profit, zero loss. We are having zero profit, zero loss. But suppose if I make another 1,000 unit, then variable cost would definitely be there. But fixed cost would not be there, because fixed costs are already covered in this break even point. So up to break even point, all the fixed costs are covered and variable costs are also covered for those units, okay. But if we go beyond break even point, only variable costs keep on occurring further, because variable costs incur with the changing units, okay. As and when we change our units, the more we sell, the more we will incur the variable cost, correct. But fixed cost do not perform like that, okay. So for fixed cost, I can say that fixed cost is a fix, like it do not change with the changing units, correct. So that's what I'm saying, that for these, at this margin of safety, there would be only variable cost, there would be only variable cost. So see, margin of safety is given to us, it is the total profit. This is the margin of safety, this is the total profit. Sorry, not profit, margin of safety is a level of sale over break even. So this is margin of safety, but profit figure is given to us. See in the question, profit figure is given to us. It is 69120 and 17500. 69120 and 17500. Now see, since we do not have any fixed cost over margin of safety for, so I can say in this margin of safety sale, there would be only two components. One is variable cost and one is profit. So you can say variable cost plus profit equal to margin of safety. Variable cost plus profit is equal to margin of safety. Okay. Profit is given to us. What is variable cost? What is variable cost? Calculate. It is 218,880 and 122,500. This is the variable cost. Correct. Now the next thing. Okay. Now if this is the variable cost, can we calculate the PV ratio? Profit volume ratio. What is profit volume ratio? Contribution upon sale multiplied by 100. Okay. Now for the margin of safety sale, we know that contribution is equal to profit because there is no fixed cost. You know what is the how the cost sheet is prepared. Sale minus variable cost is equal to contribution minus fixed cost is equal to profit. Correct. Now see, if we do not have any fixed cost, if fixed cost is zero, suppose it is sale is 100, if variable cost is 60, contribution is 40. If fixed cost is zero, profit would also be profit 40. Okay. So we can calculate PV ratio by saying profit upon sale multiplied by 100. Okay. So profit is 69120. Sale is 288,000. Only margin of safety sale. Margin of safety sale. Okay. Because we are calculating it over margin of safety. Up to margin of safety, or I can say up to break even, we can say there is zero profit, all the fixed costs are covered, and profit up, variable cost up to break even sale is covered. So you can say variable cost for 1,80,000 units, variable cost for 1,80,000 units plus fixed cost, variable cost for 1,80,000 units plus fixed cost is uh, what it is? It is 4,32,000. Okay, because this is break even sale. I hope you guys know, we have already read this. Break even sale is fixed cost plus variable cost for break even unit. This we have already read. Okay. So up to break, this is break even sale. So it includes fixed cost plus variable cost for break even point. Now what we need, what question is asking us? Question is asking us to calculate what is the saving in fixed cost. How we can calculate saving in fixed cost? We know the break even sale figure. Okay. We need to calculate the variable cost for break even units. We need to calculate variable cost for these 1,80,000 units. If we calculate the variable cost for 1,80,000 units, we can simply calculate fixed cost. and we can calculate, once we calculate the fixed cost, we'll compare that fixed cost with the fixed cost given to us. And if we'll compare this, we can simply find out the reduction. Okay. So basically PV ratio we are calculating. PV ratio is 69120 divided by 288,000. It is 24%. And for this, the PV ratio would be, what is the profit? Profit is given to us, it is 17,500 divided by 1,40,000 multiplied by 100. So it would be 12.5%. Correct. So this is the PV ratio, or this is the value of contribution. Okay. Now, if it is PV ratio, what is the variable cost ratio? If it is the PV ratio, 24% is the PV ratio, what is the variable cost ratio? If 24% is the PV ratio, suppose 24% is the total contribution incurred. It is the value of contribution. Okay. Sale minus variable cost equal to contribution. So if contribution is 24, sale is 100, what is the variable cost? 76. Easy. So you can say variable cost is 76% and 87.5%. It is the variable cost, value of total variable cost. 76% and 86.5%. So you can simply calculate now that what would be the variable cost out of this for like 32,000. So variable cost up to break even point. Slash. Okay. So up to that point, up to the break even point, we know that the variable cost ratio is 76%. We know the variable cost ratio is 76%. Okay. So see, break even sale is 4,32,000 and 2,10,000 minus variable cost. It is 76% of this and 87.5% of this. So it is 76% and 87.5%. Calculate 432 multiplied by 0.76. It would be 328. 320. And the second one is 87.5%, 2,10,000. 0.615. It is 1,83,750. Now, what is the fixed cost? $103,680 and 26,250. See, one of the reason why I made this question so longer, I explained each and every concept of this question just because I can make a revision of the break even point as well. Okay, we have made a good revision of all the concepts of break even point, but it would be useful only when you have attended the break even point chapter first. Okay, when you have seen the lectures, when you have gone through the questions, you know the basic concepts, then I think it would be much easier for you. It would be a best revision for you. Okay. And I hope you understood the complete question. Okay. So I made you understand the complete all the topics of the break even point, margin. What is margin of sale? What is margin of safety? What is how we calculate? What is the meaning of break even point? What are the concept components of break even point? So we understand all the things. So this is the fixed cost. Now, what is the fixed cost given? So you can say previously occurred fixed cost. It is 1,08,000 and 27,000. Correct. So saving in fixed cost, it would be 4,320, correct, and 750. Done. Let's see the solution once. So it is asking us to calculate reduction in fixed expenses product wise. So it is 4,320 and 750. So this was our last chapter, I can say, not last chapter, uh, another chapter, the cost reduction and cost control. I hope you understood the concepts. I hope all things are clear to you. Still, if you have any doubt, please let me know. You guys have my mail ID. So that is all from my side for the day. Have a very nice day. Bye bye.